painting a positive picture and taking the shine off gold in today's trade. Will the pressure on the precious metal continue? Harry Colvin has joined us. He's a director and senior economist at Longview Economics. Hello, very nice to see you. Under any measure that I've been looking at versus the broader equity markets, gold's been an absolute dog, and yet just looking at your notes, you think gold should rally meaningfully in coming months and quarters. Why, sir?
Well, look, there are lots of contrarian reasons telling you that gold's poised for quite a big rally. You look, for example, at speculative positions, they've unwound considerably. Sentiment used to be quite bullish, it's now bearish. Fund flows into the physical market are rolling over. You know, on a contrarian basis, there's a good argument to own gold. The real reason, though, is QE3. The Fed are expanding their balance sheet at $85 billion a month. And that's just a similar kind of pace to what they were doing in QE1 and QE2. And, of course, it injects liquidity into markets, it debases the dollar, and it underpins the rally in gold price.
You said yourself, the specs are giving up on their long positions in gold. If they're giving up, they must think, actually, this is not a good place to be.
The speculators always give up on gold at the lows. Everyone's always bearish at the lows. That's the time to buy it. We're going to get a good rally this year, I think.
Of course, the argument that investors in shares would make on the other side of this is, where's the dividend? Where's my return on gold? Unless the capital value goes up, basically I'm just stuck in a lump of metal that is not doing very much to excite me. So let's bring in our next guest. Justin Cooper is with us, the CEO of Capita Registrars, and he's been looking at the dividend payout for UK businesses, which, I guess, if we contrast against what gold's done over the last 12, 18 months, the dividend payout's actually been quite interesting. It's been an interesting place to be. Dividend payouts have gone up. Do they continue going up?
Well, it's a very interesting market. We've just recently produced our quarterly review. That allows us to do our 2012 versus 2011 trend analysis. And I think the real positive things here is we've seen record payouts of £80.4 billion in 2012, which is up some 11.2 billion versus 2011. That's some 16.2%. I think in answering your question, the 2013 forecast, well, we're forecasting an underlying at 78.6 billion, and that's actually up again some 6.7% versus the 2012 numbers, if you exclude the big one-offs, the special dividends.
So why are they increasing dividends? Is it because the market doesn't see any growth, or individual companies don't see any growth, so they've got to keep shareholders on side?
Well, I think that's a very good point. I think, we're seeing some vociferous calls for dividends from shareholders. I think that we probably see that dividends cannot outstrip wider GDP growth indefinitely. I think that what we probably will see in terms of understanding that we cut our forecast from 9% to 6.7% in 2013, companies do need to invest. They do need to keep their profits up, and they do need to protect their balance sheets. I think in 2013 we'll probably see some more M&A activity starting to emerge as well.
I think a number of themes here. Theme number one is that worldwide corporate cash remains at a very high level. I was arguing earlier in the programme that corporate investment spending is actually going to turn up on trend. So probably dividend growth actually is going to be less rapid than it has been over the last year. Having said that, I think we're in for at least 2 years where dividend yields in most markets will be higher than government bond yields, and that actually is a very strong positive for global equity markets, and a strong positive for what has been a very good strategy in the last year or two, which is a high dividend strategy. Just on gold, I'd just like to challenge you on a couple of issues, and I would argue that to get back into a bull market on gold, we need inflation. All investors worldwide are very worried about inflation, but today we don't have inflation. We also need a deterioration in bank risk, and I would actually argue, thank God, we've actually got a positive improvement in bank risk. So that's a negative for gold. I think we also need, a breakdown in confidence in paper currencies, and frankly, that's not happening. No, dollar-euro is reasonably stable at the moment. The key question is, when does inflation come back? Because that would be the bull case for gold. And frankly, short term, i.e. the rest of 2013, I don't see it.
Yeah, look, we don't need inflationary pressures for a gold price rally. We didn't have inflationary pressure. We haven't had inflationary pressures in recent years.
Correct.
The only inflationary pressure we have is from QE pushing commodity prices up. You look around the world, there's lots of deflation in the West. US wage inflation is at a 60-year low. There's a big output gap. There's loads of unemployment. There are deflationary pressures, and that's why we've got the Fed stepping in to build inflationary pressures, to do QE, to get asset prices up, and create a wealth effect and try and get the economy going.
But that's been the old story as to how gold's traded. This is a commodity that keeps changing its colours. It's risk. It attracts the risk on money, then it's risk off because of what's happening in terms of people wanting to take money out of the system and park it somewhere safe. The next phase means that it has to be a risk on trade, doesn't it? And it's just not responding to that, and hasn't for the past couple of months.
Gold doesn't really change its colours. It's since 1971, the end of Bretton Woods, long-term trends in gold prices have been determined almost entirely by real interest rates in the US.
But we have seen breakdowns in the correlations. Typically with the US dollar, there have been periods in the past couple of years where gold hasn't performed as it normally would.
Look, gold's gone sideways for 16 months. That's because the balance sheet in the Fed has gone sideways for 16 months. The balance sheet is about to expand rapidly, and with that, we're going to get a rally in the gold price. It's going to go hard this year and probably into next.
Well, I think an interesting question is what sort of rally? And, I can sit here and put forward a case for gold prices over the next 6 months or so, in a trading range of 1,500 to perhaps 1,850. But do you think we're going to have a rally which is going to break out of that range? Because at the moment we're stuck.
No, we're going to get a rally that breaks out of that range. We're going to get a rally that was similar to the rally we got in QE1 and QE2 when the balance sheet expanded and inject liquidity into markets. That's
so a rally of $300 to $400.
Yeah, I think we'll get over 2,000 and we could go higher. It depends on how much QE they do.
Justin, that's the competitor for those seeking some form of yield as well. Just tell me how this works with the companies at the moment. Is it the investors coming in and demanding increased dividend yield, or is it actually those investors are coming in because the CEOs don't know what to do with the money and actually are increasing the yield, making it more attractive? Who's leading this search for yield here?
Very opinion-based answer here. I think that we've seen vociferous calls from investors for higher yields from dividends. To answer your point earlier, we've seen that at 4.5% gross. I think you've got to hunt around to see whether you can get any better than that. Look at the property market, look at bonds, look at bank interests. Definitely, I think companies are in rude health. I think we see share equities at the moment, you could argue, are the only show in town. And
just quickly, is it new class of investors? We keep getting told about fixed income investors searching for yield in the equity space. Is there evidence of that?
I think I think you'll see a balanced portfolio. I think there's the historic traders, and I think you might see some new investors as well who have been driven out of low yields on bank interest.
Yeah, great.
Justin, thank you for that. Justin Cooper, with us from Capita. Harry Colvin, Director and Senior Economist at Longview Economics. Thanks for coming in and making the case for gold. And Bob, always a pleasure to see you.
Thank you.
Bob Parker, Senior Advisor at Credit Suisse. Thanks for tuning in, everybody. I hope you enjoyed the conversation around the desk. Let us know. Squawkbox Europe at CNBC.com. Stuart Richardson will be in tomorrow as our guest host. Have a safe day if you're in the markets. And stay tuned. Worldwide Exchange up right after this.